The instant you hit 70 and a half, the IRS quietly opens up 7 provisions that can trim thousands of dollars off your tax bill every year. Not next year, not when RMDs kick in, right now at 70 and a half. And the overwhelming majority of retirees will never tap into a single one of them because nobody bothers to explain that the rules shift at this precise age. Most folks assume 70 and a half is irrelevant. They figure the milestone ages are 59 and a half when the early withdrawal penalty vanishes, 62 when Social Security opens up, 65 when Medicare kicks in, and 73 or when RMDs start. Those ages soak up all the spotlight. 70 and a half gets brushed aside, and that oversight costs retirees genuine money every year they let it slip by. Today, I'm going to walk you through all 7 provisions. Each one trims your taxes, shields your Social Security from getting pushed into the taxable zone, or protects you from Medicare surcharges. Some of them you can arrange in 15 minutes. One of them can save you more than every other retirement tax strategy put together. And the window for using some of them slams shut the moment RMDs begin. Before I dive in, I need to be upfront. I'm not a lawyer, I'm not a CPA, I'm not a financial advisor. Nothing in this video constitutes legal, tax, or investment advice. These are educational illustrations grounded in current tax law and publicly available IRS information. Always consult a qualified tax professional regarding your specific situation. My name is Timothy, and if you're new here, this channel serves one specific audience: retirees and pre-retirees over 60 who want to grasp how the IRS truly operates in retirement. Not the watered-down version your brokerage prints in their newsletter, the genuine version with real numbers in plain English. If that describes you, subscribe right now because the video I'm releasing next week will reveal exactly what the IRS allows you to do at 59 and a half, and that one could reshape your timeline. Drop a comment right now. Are you over 70 and a half? Just yes or no. I read every single comment, and the breakdown between yes and no will determine whether my follow-up video focuses on how to apply these provisions or how to gear up for them before you arrive there. 2 seconds. Do it now. Let us dig in. Number 1. The Qualified Charitable Distribution. This is the single most powerful tax instrument available to any retiree past 70 and a half. And most people either don't realize it exists or fail to grasp how valuable it is. Beginning at exactly 70 and a half, you can move money directly from your traditional IRA to a qualified 501c3 charity. That transfer is known as a Qualified Charitable Distribution, or QCD. The cap for 2026 sits at $111,000 per person. If you're married and both partners are over 70 and a half, you and your spouse can each send $111,000 from your own IRAs for a combined $222,000. Here is what makes the QCD so potent. The funds travel directly from your IRA custodian to the charity. They never land in your bank account. They never show up on your tax return as income. They don't bump up your adjusted gross income. They don't bump up your provisional income. They don't push your Social Security into the taxable zone. They don't trigger IRMAA Medicare surcharges. It is completely invisible to every tax calculation the IRS performs on your return. And once you reach the age when RMDs begin, the QCD applies toward fulfilling your required minimum distribution. So instead of pulling $15,000 out of your IRA, paying tax on it, and then writing a check to charity from your bank account, you direct that $15,000 straight from the IRA to the charity. The RMD is fulfilled. The tax is zero. The charitable impact is identical. The only difference is that the IRS receives nothing. Compare the two methods. Without a QCD, you pull a $15,000 RMD. It registers as income. It drives your provisional income upward. Up to 85% of your Social Security becomes taxable. At a 12% bracket, the tax on the RMD itself runs about $1,800. Plus, the additional tax from the Social Security cascade adds another $500 to $1,000. Total tax cost of donating $15,000 to charity the conventional way, roughly $2,300 to $2,800. With a QCD, the total tax cost of donating the same $15,000 to the same charity? Zero. You save $2,300 to $2,800 by altering how the funds traveled from your IRA to the charity. Same gift, same charity, same amount, different path. Thousands saved. If you donate to charity in any amount from $500 to your church to $50,000 to your alma mater, and you're over 70 and a half, and you're not channeling it through a QCD, you are giving the IRS money you don't need to give them. Phone your IRA custodian tomorrow. Fidelity, Schwab, Vanguard, they all make this simple. You complete a form, name the charity, and they mail the check directly. It takes 15 minutes to arrange, and it saves you genuine money every year for the rest of your life. Let me share a concrete example so you grasp the full impact. A married couple, both 72, they donate $8,000 yearly to their church and $2,000 to a local food bank. Total charitable giving, $10,000 each year. They have been writing checks from their bank account for 20 years. Their income is Social Security of $38,000, IRA withdrawals of $25,000, and savings interest of $3,000. The provisional income is $25,000 plus $3,000 plus $19,000, which represents half their Social Security. That totals $47,000. Above the $44,000 joint threshold, 85% of their Social Security is taxable. Roughly $21,140 of their Social Security gets added to their taxable income. Now, observe what unfolds when they channel the $10,000 in charitable giving through QCDs rather than bank account checks. They withdraw $15,000 from the IRA for living expenses instead of $25,000, and the remaining $10,000 flows directly from the IRA to the church and the food bank as QCDs. Their adjusted gross income falls by $10,000. Their provisional income drops from $47,000 to $37,000. They shift from the 85% zone into the 50% zone. The taxable share of their Social Security falls from $21,840 to roughly $5,000. Their federal tax falls by approximately $2,000. They donated the same $10,000 to the same charities. Their lifestyle stayed identical. They simply altered the path the money took. And that path change saved them $2,000 each year. Across 10 years, that totals $20,000 on a $10,000 yearly donation. There are three frequent mistakes folks make with QCDs. First, they have the IRA custodian mail the funds to them, and then they write the check to charity. That fails to qualify. The funds must go directly from the custodian to the charity. You never handle them. Second, they attempt to use a QCD with a donor-advised fund. Donor-advised funds do not qualify for QCDs. The funds must flow to an operating 501c3 charity. Third, they execute the QCD one day before turning 70 and a half. The IRS is unforgiving. You must be 70 and a half on the day the distribution occurs. Not 69 and 11 months, not 70 and 5 months. 70 and a half. Verify your exact date before your first QCD. Were you aware of QCDs before this video? Drop yes or no in the comments. I'm genuinely curious because this is the provision that saves more money than any other for retirees who give to charity. And most people have never heard the term. Number 2, the one-time QCD to a charitable remainder trust or charitable gift annuity. This one is fresh. The Secure 2.0 Act introduced a provision that allows you to make a one-time QCD of up to $55,000 from your IRA to fund either a charitable remainder unit trust, a charitable remainder annuity trust, or charitable gift annuity. This is a lifetime cap, meaning you can only do it once. Here is why this counts. A charitable gift annuity or charitable remainder trust pays you income for the remainder of your life, and then the leftover assets pass to the charity when you die. Ordinarily, funding one of these with IRA money would require you to withdraw the funds, pay income tax on the withdrawal, and then contribute the after-tax sum. With this provision, you fund it directly from the IRA via a QCD. No income tax on the transfer. The charity gets funded. You receive a lifetime income stream. The IRS receives nothing on the initial transfer. On $55,000, the tax savings on the transfer alone at a 22% rate equals $12,100. Plus, you sidestep the Social Security cascade and IRMAA exposure that the withdrawal would have triggered. The total tax benefit can surpass $15,000 on this transaction. This isn't for everyone. It requires partnering with a charity that offers gift annuities and grasping the payout rates and terms. But for retirees who are already charitably inclined and have sizable traditional IRAs, it stands as one of the most tax-efficient avenues to generate guaranteed income while supporting a cause you care about. Number 3, the pre-RMD IRA reduction window. This is the provision that most retirees completely overlook because they don't understand the calendar. QCDs begin at 70 and a half. RMDs don't kick in until 73 if you were born before 1960 or 75 if you were born in 1960 or later. The gap between 70 and a half and the start of RMDs creates a window of 2.5 to 4.5 years where you can deploy QCDs to shrink your IRA balance before the IRS starts forcing money out. Why does this count? Because RMDs are computed based on your IRA balance as of December 31st of the prior year. The larger that balance, the larger the forced withdrawal. The larger the withdrawal, the more Social Security gets taxed, the more likely you are to trigger IRMAA, and the higher your effective tax rate. If you deploy QCDs during the pre-RMD window to reduce your IRA balance by $50,000 to $100,000, your future RMDs shrink correspondingly. On a reduction of $100,000, your first RMD falls by approximately $4,000 each year. That $4,000 less in forced income keeps your provisional income lower, keeps your Social Security in a lower taxation zone, and possibly keeps you below the RMD threshold. The pre-RMD window is finite. Once RMDs begin, you can still execute QCDs, but the first dollars out of your IRA must fulfill the RMD before any additional QCD counts. The strategic edge of trimming the balance before the clock starts ticking is enormous, and most people don't even realize the window exists. Let me walk you through the math on this. A retiree turned 70 and 102 in 2026 with a traditional IRA of $500,000. RMDs will begin at 75 because she was born in 1960 or later. She has 4 and 102 years in the pre-RMD window. If she executes QCDs of $15,000 per year for 4 years, she shrinks the IRA by $60,000. At 75, her balance sits at roughly $510,000 with growth instead of $570,000. Her first RMD falls from approximately $23,170 to approximately $2,732. That equals roughly $2,438 less in forced taxable income every year for the rest of her life. At the 12% bracket, that saves her roughly $293 per year in direct tax on the RMD, but the cascade effect on Social Security taxation saves her an additional $400 to $600 per year. Combined annual savings roughly $700 to $900. Across 20 years, that adds up to $14,000 to $18,000 saved all because she leveraged the pre-RMD window to shrink her balance by $60,000 through QCDs that she planned to make anyway. Number 4, the last Roth conversion window before RMDs complicate everything. If you're 70 and 102, you have between 2 and 102 and 4 and 102 years before RMDs commence, depending on your birth year. This represents the tail end of the gap years, and every year of conversion space that remains is precious. Once RMDs begin, Roth conversions don't cease being possible, but they grow much harder to execute efficiently. Your RMD must come out first before any conversion. That RMD fills the lower tax brackets. The conversion then stacks on top, often landing in the 22% bracket or beyond. At 70 and 102, if your income is managed, you may still have room in the 12% bracket to convert $30,000 to $50,000 each year. At 73 or 75, when the RMD fills $15,000 to $25,000 of that bracket space, your conversion room at 12% shrinks dramatically. The math is straightforward. Every dollar you convert at 12% now saves you 10 to 18 percentage points on that dollar later, when it would have emerged as an RMD at 22 to 30% effective rate, including the Social Security cascade. On a $50,000 conversion, that translates to $5,000 to $9,000 in lifetime tax savings per year of conversion. If you're 70 and 1-2 and you haven't begun Roth conversions, you're in the final window where the math works in your favor. After RMDs commence, the window doesn't close entirely, but the benefit shrinks each year. Let me illustrate why the math shifts so dramatically once RMDs begin. At 70 and 1-2 with no RMDs yet, a single filer with Social Security of $30,000 and $2,000 in savings interest has taxable income. After the standard deduction of $18,150 of roughly $13,150, she sits in the 12% bracket with over $36,000 of room before reaching 22%. She can convert $36,000 at 12%. Total conversion tax, roughly $4,320. Now jump ahead to 75 when her RMD begins. Same Social Security, same savings interest, but now her RMD of $18,000 is forced into the brackets first. After the standard deduction, her taxable income before any conversion is roughly $31,150. She has only $18,550 of 12% space remaining. Her conversion capacity at the lowest rate just dropped by half, and it gets worse every year. At 80, the RMD percentage is higher. At 85, higher still. By 85, the RMD alone may consume most of the 12% bracket, leaving almost no room for conversions at favorable rates. There is also the IRMAA factor. Every dollar of Roth conversion counts towards your modified adjusted gross income. At 70 and 102, if your May GI is under $109,000 as a single filer, you can convert up to that ceiling without triggering Medicare surcharges. But remember the 2-year lookback. A conversion you execute at 70 and 102 in 2026 affects your Medicare premiums at 72 and 102 in 2028. Plan the conversion amount with one eye on the tax bracket and the other eye on the IRMAA tier. The conversion still nearly always makes sense, but you need to know the full cost. Number 5. The new code Y on your 1099-R. This one isn't a strategy. It's a reporting update that addresses a problem retirees have been wrestling with for years, and almost nobody is aware of it. Beginning with the 2025 tax year, the IRS rolled out Code Y for Box 7 of Form 1099-R. This code specifically marks a distribution as a qualified charitable distribution. Before this code came along, QCDs were reported as ordinary distributions on your 1099-R. Your tax software treated them as taxable income. You had to manually back them out on your return, and if your software or your preparer didn't manage it correctly, you paid tax on money that should have been tax-free. This occurred constantly. Retirees would execute a QCD, assume they were finished, and then learn in April that their tax software counted the distribution as income. They overpaid. Some of them never spotted it. Code Y eliminates that headache. When your IRA custodian issues the 1099-R with Code Y in Box 7, your tax software automatically recognizes that this distribution was a QCD and removes it from income. No manual tweak, no margin for error. If you executed a QCD in 2025 or earlier, and your preparer counted it as taxable income, you may have overpaid. You can submit an amended return within 3 years to correct it. Review your 2025 1099-R. If the QCD is marked with Code Y and it was counted in your taxable income on your return, that represents money the IRS owes you back. If you've made it this far in the video, you're precisely the kind of person this channel exists for. Hit the like button right now. It takes 1 second and it signals YouTube to surface this to more retirees who need to hear it. And if you're not subscribed, do it now. I see your comments every day. The most frequent one is, how do I figure out what this means for my situation? That's why I built a guide that teaches you how to use AI tools to answer any retirement tax question with your own numbers in minutes. If these videos are valuable to you, that guide is the next step. goldenrights.shop link in the description. Number 6, Social Security Maximum Benefit plus Provisional Income Management. If you postponed Social Security until 70, your benefit now sits at its peak. For every year you delayed past your full retirement age, the benefit grew by roughly 8%. At 70, your benefit equals 132% of your full retirement age figure. That is locked in permanently with cost of living adjustments stacked on top. At 70 and 102, you've been collecting that maximum benefit for 6 months. And now the question pivots from when should I claim to how do I shield what I'm receiving from being taxed? The answer is provisional income management. And 70 and 102 is the age when this becomes the most important calculation in your financial life. Your provisional income equals your adjusted gross income plus any tax-exempt interest plus half your Social Security. If you're a single filer and your provisional income surpasses $34,000, up to 85% of your Social Security is taxable. For a married couple filing jointly, the threshold sits at $44,000. At 70 and 102 with a maximum Social Security benefit of roughly $40,000 per year, half of that equals $20,000. That $20,000 enters your provisional income before you've withdrawn a single dollar from any other account. You only have $14,000 of breathing room before crossing the $34,000 threshold as a single filer. This means every dollar of additional income matters enormously. A $10,000 IRA withdrawal pushes you to $34,000 and triggers the 85% zone. A $10,000 QCD instead of an IRA withdrawal keeps you at $24,000, comfortably below the threshold. The QCD kept your Social Security tax-free. The IRA withdrawal would have rendered $20,000 of your Social Security taxable. At a 12% rate, that translates to $2,400 saved every year from one decision about how to move $10,000. This is why 70 and 102 is so critical. The QCD becomes accessible at exactly the age when provisional income management becomes vital. The two provisions work together seamlessly, and the IRS doesn't explain the link. Number 7, the senior bonus deduction stacked with QCD and Roth income. The One Big Beautiful Bill, enacted into law in 2025, established a $6,000 deduction for taxpayers 65 and older, $12,000 for a married couple where both are 65 or older. The income phase-out begins at $75,000 for single filers and $150,000 for married filing jointly. At 70 and 102, you're well past 65. The deduction applies to you, but the genuine power isn't the deduction by itself. It's the deduction stacked with QCDs and Roth withdrawals. Here's the stack. Here is, you need $50,000 to live. Social Security delivers $30,000. You need $20,000 more. You draw $10,000 from a Roth IRA, tax-free, invisible to the IRS. You execute a $10,000 QCD from your traditional IRA to your church, fulfills part of your charitable giving, invisible to the IRS. Your adjusted gross income consists solely of your Social Security. Your provisional income equals $15,000, beneath the $25,000 threshold. 0% of your Social Security is taxed. The senior bonus deduction lowers your taxable income further. Your federal tax bill is essentially zero. You lived on $50,000 and paid zero in federal income tax. Lawfully, because you stacked 3 provisions that all become accessible by 70 and a half. Now, contrast that with the retiree who pulls the full $20,000 from a traditional IRA rather than splitting it between Roth and QCD. Their provisional income leaps to $35,000. They cross the $34,000 threshold. 85% of their Social Security is taxable. Their federal tax bill runs roughly $2,000 to $3,000. Same income, same lifestyle, one retiree pays zero. The other pays $3,000. The difference is knowing about 3 provisions and stacking them. The IRS will never describe this combination to you. Your tax software will never propose it. Most tax preparers will never model it unless you ask. And if you reside in one of the 8 states that still tax Social Security, in 2026, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, the stacking strategy saves you at the state level too. Every dollar of Social Security that remains outside the taxable zone is a dollar that your state cannot reach either. In Minnesota, where the state exemption phases out at higher incomes, holding your provisional income low through QCDs and Roth withdrawals can spell the difference between a full state exemption and no exemption at all. One critical caution about the senior bonus deduction: it is temporary. It runs from 2025 through 2028 only. After 2028, unless Congress extends it, the deduction vanishes. That means you have 3 more tax years to use it. If you're 70 and a half right now in 2026, you have 2026, 2027, and 2028. 3 years. At $12,000 per year for a couple, that totals $36,000 in deductions, saving you roughly $4,820 at the 12% rate. After 2028, that savings is gone. Use every year of it. Let me tie all 7 together. At 70 and a half, the IRS unlocks the QCD, which lets you donate up to $111,000 per year from your IRA tax-free. It unlocks the one-time QCD to a charitable remainder trust or gift annuity for up to $55,000. It opens the pre-RMD window where QCDs can shrink your IRA before forced withdrawals begin. It hands you the last clean Roth conversion window before RMDs compress your bracket space. It introduces code Y on your 1099-R so your QCDs are reported correctly for the first time. It makes provisional income management vital because your maximum Social Security benefit is now flowing. And it lets you stack the senior bonus deduction with QCDs and Roth withdrawals to potentially achieve a 0% effective tax rate. 7 provisions, all accessible right now if you're 70 and 1 to 2 or older, and the IRS will not describe a single one of them to you. Here is what I want you to do right now. 3 things. First, if you give to charity in any amount, and you're over 70 and 1 to 2, phone your IRA custodian this week and arrange a QCD. Fidelity, Schwab, Vanguard, all of them have a simple form. It takes 15 minutes. Begin with your next charitable gift and channel it through the IRA instead of writing a check. Second, calculate your provisional income. Take your AGI, add any tax-exempt interest, add half your Social Security. Where do you fall relative to the 25,000 and 34,000 thresholds? If you're above 34,000, examine how much of that income could be replaced with Roth withdrawals or QCDs. That's the money you can reclaim from the IRS. Third, examine your 2025 1099-R. If you executed a QCD last year, look for code Y in box 7. If it's there and your return counted that amount as taxable income, you overpaid. Submit an amended return. Drop a comment and tell me which of the 7 provisions surprised you the most. Just the number, 1 through 7. That number tells me exactly what to cover in the next deep dive video, and the most common answer becomes next week's full episode. If this helped you, hit like. Subscribe if you haven't already. I produce videos like this every week, and if you have any specific question about your own situation, my guide at goldenrights.shop teaches you how to answer it yourself using AI. Link in the description. I'll see you in the next one.